Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri. I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. Last week, U.S. equities posted one of their strongest week in months, going into a shortened holiday week led by large cap tech and long duration growth, while bonds generally rallied as falling rate expectations pulled yields lower. So within that move, leadership and laggards were quite concentrated. U.S. tech, AI-exposed names, and healthcare defensives outperformed, while housing-linked cyclicals and some value and cyclical segments underperformed. So let's hop into our discussion this week, starting with our key market indicators, as well as we'll continue our discussion by reviewing the contributors or detractors of the market. Once again, all of this is focusing on highlighting the key drivers of the market. And we'll do this all while looking at both equity and bond markets to provide a more comprehensive view of market movement and the impact to your portfolios. So with that, let's hop right in. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected 3.9% growth as of November 26th, which is down 0.3% from last week. This is largely driven by real third quarter gross private domestic investment growth, which decelerated from 4.4% to 3.5%. Next, each week, we look at the initial claims for unemployment insurance for a gauge into the front end of the labor market. This week, initial claims ended at 216,000, while continuing claims ended at 1.96 million. Initial claims have started to come down. However, continuing claims remains relatively high, staying above the $1.9 million average since May. This is showing that more people are staying on unemployment longer, and also we've seen the unemployment rate tick higher very recently to 4.4%. Next, we're watching mortgage rates closely to see how home affordability is trending. This week, we saw minimal movement once again in mortgage rates, where the 30-year and 15-year mortgage rates ended at 6.23% and 5.51% respectively. We don't have any updated data on the bull-to-bear spread this week due to the short week, but we'll certainly watch this next week and make sure to report out any changes and updates as we get more data available. Now, while looking at sentiment, you all know we look at two forms of sentiment. One is that bull-to-bear spread. The second is the volatility index, or the VIX. Remember, generally, the VIX rises when stocks fall and declines when stocks rise, often showing that inverse price to action relationship to the S&P 500. Remember, VIX values above 30 are typically linked to large volatility resulting from increased uncertainty and fear, while values below 20 generally correspond to stable market periods. This week, the VIX ended at 16.35. And next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating an 86.4% probability of a 0.25% decrease and a 13.6% probability of no cut in December. The markets are starting to lean more towards a cut in December based on this data. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 3.74%. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, was positive 5.55%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the U.S., was positive 3.26%. So the winner this week goes to, well, our aggressive growth or mid-cap stocks. Wonderful week to see. And it was a short week too. So remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. Now, if you'd like an unbiased review of your portfolio, please do not hesitate to connect with one of our advisors today. So with that, let's jump right into the discussion around contributors and detractors that moved these market indices in the past week. All right, let's talk about the key contributors and detractors of the market movement last week. Specifically, first, let's look at the equity market and the key contributors there. The expectation of a December rate cut and a softer path for policy supported a rotation back into long duration growth and quality, lifting U.S. indices sharply throughout the week. The NASDAQ composite outpaced the S&P 500 and the Dow Jones Industrial Average, reflecting that growth tilt. As mentioned, technology was the primary sector engine, with AI-adjacent hardware, custom silicone, and software and application names leading the markets as they repriced the earnings and the discount rate outlook. Defensive growth pockets, particularly healthcare and select consumer platforms leveraged to digital spending, attracted flows as investors sought a blend of duration and earnings resilience. Now, the key detractors in the market, specifically the equity market, were linked to housing. Housing-linked and home improvement cyclicals lagged as the locked-up housing market and the elevated mortgage rates continued to put pressure on renovation and transactions, which traditionally drive spending. On the bond market, switching over to the bond market, taking a look at some of those contributors, the expectations of an upcoming federal rate cut and ongoing disinflation supported a further rally in U.S. Treasuries, with the benchmark 10-year yields edging lower and extending a multi-month downtrend. Within credit, mortgage-backed securities and high-quality corporates benefited from lower rates and a constructive risk backdrop, tightening spreads modestly in line with the equity rally. Now, the key detractors on the bond market side, we saw some shorter maturity and floating rate exposures underperform longer duration assets as the yield curve adjusted to greater odds of policy easing, reducing the relative carry advantage of front-end instruments. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, please make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Once again, thank you for watching. We look forward to seeing you next week.